Bed Bath & Beyond is failing today big time, and it's bad. The company just announced that they were selling a massive amount of shares to raise capital, which is basically a Hail Mary attempt to try to get cash to stay alive. And you might be thinking, well, of course they're struggling. This is a retail business in the world of dropshipping and e-commerce. But actually, Bed Bath & Beyond's sales grew for 26 consecutive years up until 2018. But now, annual sales have fallen to half of what they were at the business's peak. So how does a company with 2 decades of consecutive sales growth go boom so fast? And recently, the stock doubled in one day, so of course, being the astute investors that we are, you have to wonder if you can make money on Bed Bath & Beyond stock, either buying the stock for a quick buck or shortening the stock if you think it's a failing business. To understand why Bed Bath & Beyond is struggling so bad right now, you'll probably want to understand how the company got started. Bed Bath & Beyond started in 1971 as a single store called Bed & Bath. From the start, the company took a different approach to selling its products. Most retail stores spent heavily on advertising to attract new customers and to stay relevant in their customers' heads. However, Bed Bath & Beyond never spent any money on a branding campaign. You'd never see a commercial for Bed Bath & Beyond or newspaper ads, which was unique. They also decided that they wouldn't run sales or change prices on their products, which, again, were common practices in the retail industry. So how in the world are these mad lads going to get people in their store if they do zero advertising and never run sales or offer discounts on their prices? Where's the corporate riz? Every business relies on promotion and leverages advertising to some extent. That's why you see clickbait thumbnails and titles on YouTube. Life is business, friends. Oh, and while we're on the topic, could you kindly destroy the like and subscribe buttons for the algo? Thanks, gang. No advertising, sales, or shameless self-promotions. So how did Bed Bath & Beyond grow? The company brought a marketing leader in named Rita Little, and she revolutionized the company's marketing strategy, which would change the company's fate. When she was brought into the company in 1997, the company was at 60 stores, and it was her goal to help the company grow to 100 plus stores, which is actually a pretty big goal. Think about it, that's a 66% increase in store count. In order to grow the business, she'd need to drastically increase sales so the company could afford to grow more aggressively. It started almost by accident. The company was looking for something different for its 4th of July promotion, so they tried adding a 20% off coupon for an item in the store, and it really worked. With one hell of a successful promotion, Bed Bath & Beyond hired an outside agency to help them scale these coupons. They ended up designing big, blue, 20% off coupons, and they became an icon for what Bed Bath & Beyond stood for. Interestingly, even though the coupons had expiration dates, the coupons never actually expired. Talk about mind games, am I right? Employees were instructed to accept all 20% off coupons, even if the coupons had technically expired. Why does this matter? The company didn't do advertising, and it didn't have a price-changing strategy to drive customers to the store. The company was built on a strong 20% off coupon strategy to drive people into the store. This was pretty effective because people really wanted the discounts, and if someone put the coupon in their wallet to save it, the coupon sitting in their wallet basically becomes free advertising for Bed Bath & Beyond. But as you might have guessed, a business built on paper coupons and mailed catalogs might struggle to survive in today's world, where the supreme businesses that dominate today's global market focus on profitable ventures like dropshipping, cryptocurrencies, and NFTs. So where is Bed Bath & Beyond at today? Sales have been declining since fiscal year 2018, and today's sales are about half of what they were at the company's peak. Also, the company hasn't been profitable since 2017. Back in 2019, the company brought in Mark Tritton as the new CEO after activist investors tried to take over the company. Activist investors sometimes try to buy failing companies because they can buy failing companies really cheap, implement radical plans to save the company, and make a shit ton of money. You can kind of see how serious the situation was getting since activist investors were trying to take over the company. CEO Tritton tried to turn around the company, but he was fired in the summer of 2022. In October, the credit rating agency Moody's downgraded Bed Bath & Beyond from CAA2 to CA in October of 2022. A credit rating basically rates the chances that a company will repay its debt payments, and a CA rating more or less means the company has a 50% chance of default on its debt. Basically a flip of a coin on whether a company can make its payments, so that's not very cool. Doug Stevens, a retail industry consultant, sums it up perfectly. He said, if Bed Bath & Beyond was going to survive, they needed to do something probably 10 years ago to put themselves on a new trajectory toward a new model that would give consumers a sense of unique value, he said, but they didn't. Even though the future looks bleak, management has not thrown in the towel yet. The company has plans to try to grow sales by continuing to grow its Welcome Rewards program. This has actually been pretty successful. The program has now grown to over 16 million members, which is pretty remarkable since this program replaced their Bed Bath & Beyond Plus program just a year ago in June of 2022. Management also has plans to soon launch an upgraded mobile app, which can help with the online shopping experience. However, it seems like these changes might be too late for the company as it really struggles to get cash, and this is a giant problem. For the most recent quarter, sales were down 33% from where they were last year, and with sales falling, it's difficult for the company to survive because there are still high costs for the company to cover. Yeah, the company is making about $6 billion in annual sales, but they still have to buy all the inventory they sell, and they still have a lot of overhead expenses because the company owns just over 950 physical stores. Right now, about 70% of the company's sales is just used to cover the cost of goods sold, which is the cost to buy the products they sell, and about 35% of sales pays the overhead costs that are used to pay for things like stores and staff. So if we run the numbers and do the calculus, you can see they lose money on operations, and they've actually been losing money for the past 4 years. Even though the company has plans to cut its number of stores in half, from 953 to 480 stores, the company still needs some short-term cash to survive. This poor financial status led the management to recently sell a shit ton of new stocks to investors, which raises some short-term capital for the company, but it also dilutes existing equity holders. The company has received $225 million in the stock offering so far and expects to make another $800 million in gross proceeds, but even with the new $1 billion, the company is still going to be facing a lot of the same problems they've been facing for years, like having a poor e-commerce strategy and a dwindling customer base. And the balance sheet is not looking too hot at all. They've got low cash and fast approaching bills. Current liabilities exceed current assets, which means they have more bills due in the short term than the money they actually have to pay for it. The corporation has reduced its inventory by over $500 million in the past year, while also burning through $509 million in cash. Sales, cash flow, and inventory have all decreased, while long-term debt has increased, creating a disastrous situation for the company's future. The outcome was a decrease of about $1.3 billion in shareholder equity over the course of a year, and shareholders' equity is now about negative $800 million. So to summarize the situation at Bed Bath & Beyond, the company needs to find an infinite money glitch to solve its financial woes, and they need it fast. So with a company with such a poor financial status, of course, the only logical thing to do is invest your life savings now in the stock and wait for the rebound. We're just playing with you guys. We're joking. We don't want you to be posting your losses on Wall Street bets with our video link in the description of your post. So how would you play Bed Bath & Beyond? Well, something that's interesting to know is that Bed Bath & Beyond's pro forma enterprise value comes to approximately $4.25 billion, with the stock at a $3.85 price. This is significantly higher than the multi-year highs established in early 2021, when the firm was in a net cash position and enjoying substantial pandemic-related tailwinds. This means that the value to buy the whole company, so the value of all the company's stock and debt, is actually higher today than it's been in the past. And the fundamentals are dog water right now. Though it may seem illogical at first glance, remember that meme stock land isn't exactly known for its fondness with logic. Despite widespread anticipation that Bed Bath & Beyond would soon file for bankruptcy, the company's stock soared on Monday from its starting price of about $3.11 to a high of about $7. A similar short squeeze occurred in August of last year, when the share price rose from $6 per share to $23 per share in a matter of weeks before declining. And all of this was made possible by the influx of retail traders who began to acquire the stock in enormous quantities. Short interest in Bed Bath & Beyond stock peaked at 103% in August, luring retail traders who squeezed the short sellers who were overexposed to the stock for a quick profit. There's currently a 46% short interest in Bed Bath & Beyond shares, so it's much the same situation as before. So look, maybe you can cash in for a quick buck if there's another short squeeze, or maybe you think the stock's going to zero and you want to short it. If you catch the news that there's going to be another Reddit air support, maybe you can throw some money at the stock. Ultimately, you should make sure you only put in money that you'd be okay with losing. Of course, none of this is financial advice. We're just dummies that talk about stonks. The company's obviously incredibly risky, so invest at your own risk. So to wrap it up, Bed Bath & Beyond got rich by executing a very successful coupon strategy. Customers would hoard them, and people would line up to buy the sweet merch. Bed Bath & Beyond has struggled to stay relevant today with a poor e-commerce strategy and a declining customer base. They've seen declining sales and net losses for years. Today, they're in a cash struggle, so they sold a shit ton of stock to make some quick money to stay alive. Should you buy the stocks? Only if you hear good news from Meme Stock Mania. Otherwise, it's probably best to avoid the stock.